A bear market is when markets fall by 20% or more from recent highs. It sticks around for a while and it's not just a one-off dip. Think about the bear swiping its claws downward. In contrast, a bull market is when share prices rise by 20% or more after the decline. Markets are rising, confidence is high, and people are optimistic and buying. Think of that bull thrusting its horns upwards. Let's look back at the US bear market examples. Now, the ones I'm going to point out are the ones that line up with Australian bear markets. So the 1973 oil crisis resulted in the US stock market declining by 48%. It lasted 21 months, and within the first 6 months, markets had recovered 32% of that already. That means it took another 36 months to make up the other 16%. The August 1987 crash, known as Black Monday, it was a very quick decline. This lasted only 4 months in the US, but it was very sharp. 34% lost in the US stock market. Within 6 months, 21% of that was recovered. So it took another 13 months to make up the other 13%. The dot-com bubble in the early 2000s, lasted 31 months in total. 49% was lost, but within the first 6 months, 22% was made up again. Now, I wish there was a bell that said, hey, it's October 2002, this is the bottom, markets will go up from here on, but unfortunately there isn't. So staying invested means you won't lose out on that quick recovery after a market crash or drop. The global financial crisis in 2007 to 2009, this one lasted 17 months, a really big decline of 57%. But within 6 months, 39% was made up. It took another 42 months to make up the other 18%. And then lastly, the most recent official bear market was COVID. 2020 lasted for 1 month, very short, very sharp, 34%. But within 6 months, the markets had already recovered that drop, plus then some. It took 5 months to recover in the US. Now, closer to home, looking at the all odds and the bear markets that we experienced, you'll note that each of the bear markets coincided with a specific event. The top one was the 73 oil crisis. It took a while for that bear market to hit our shores, but it lasted about 9 months from January 74. The decline was 51%. And 6 months after that bottom, markets had already recovered 37%. But it took another 41 months to make up the other 14%. You might start seeing a pattern here. It is true some of the times using this data, but not every time. I'll show you the exception in a bit. But it's almost like losing weight. The first 5 or 6 kilos go really fast and easily, and then you really have to sweat for those last 4 or 5. Markets work very similarly. The recovery is quick, swift, unexpected. You don't know where the bottom is. Again, I wish there was a bell, but you don't know when that bottom is. Let's look at the 1987 crash known as Black Monday. November 87, but it lasted less than a month, but that 1 month drop was sharp, minus 50%. 6 months later, it already recovered 20% just in 6 months. Now, it isn't the majority of the losses, absolutely, but that's a big recovery in just 6 months because the other 30% took 68 months to recover from. The dot-com bubble burst lasted 12 months, hit our shores at about March 2002. This decline was 22%, but 6 months after that bottom, 18% had already been made up. It took another 7 months for the other 4%, so quick recovery that time. The GFC in November 2007 lasted 16 months, very sharp decline, minus 55%, our biggest one. By 6 months later, 42% had already been made up. It took another 118 months for the other 13% to recover, so quite a lot. And then lastly, the COVID one, which hit our shores around February 2020, just lasted a month. Decline was 37%, and 6 months later, most of that was already made up, 33%. but it took another 7 months for the other 4% again. Now, that one is quite memorable for me because I just started going self-employed. I just started my business. And I had to call up quite a few of my pensioner clients during that February-March time. February happens to be my birthday, and it was around my birthday that the crash started, and it was around my mom's birthday that the crash stopped that year. So it's quite memorable for me. And my pensioners all said, listen, we know it's because of what's happening in the world. We will stay invested. We've got enough in cash. The ones who didn't need to sell down on growth could stay invested. We planned ahead. So it really comes down to planning your portfolio based on where you are in life so that you can sit out crises like this and not touch your capital. So it really comes down to strong planning and staying the course, staying invested. Now, things you can learn and take out from this is markets have recovered every time. It rallies very quickly, unpredictably. The risk of selling when you panic and when markets start dropping is that you lock that paper loss into a real loss and that you will then lose out the recovery that is swift and fast when it does happen. We don't know when the bottom of the markets are, so staying invested, staying the course and keeping that discipline is important. Let's take a look at the 20 biggest one-day rallies from each of these markets. If you have any questions or would like to discuss your portfolios, please reach out to us. Thanks for watching.